Thank you, guys. And I assume you can hear me okay, because I can hear myself. Thank you for joining us at the 12th Annual Denver Startup Week. This session, like Claire mentioned, is part of the People track. So it's one of 8 programming tracks aimed at supporting the entire entrepreneurial team and community here in Denver. By attending this session, you're agreeing to follow our code of conduct as well as being photographed or recorded on video. So now that all the boring stuff's out of the way, my name is Allie Eklund, and we'll be talking today about building wealth in and out of your business. So my background, I have a bunch of letters behind my name. My background is primarily in tax. And so I want to focus on some of the tax aspects of being a business owner and give you some education there. I love a good theme. You will see that throughout. There's a color theme. I'll let you guess what color. And then one other thing, the hashtag Den Startup Week, you can use that if you would like. Today we'll do a quick introduction. We'll talk about ways to build wealth in your business. Then we'll pop to out of your business, quick summary about a couple additional things for your business, and then we'll have some time for Q&A. So quick introduction just on myself. Again, I'm going to try to make this fun. I am prepared taxes for the first 5 years of my career. I am a CFP. I've done that in personal finance for the last 10 years. And again, just a general certification in the industry as a baseline of technical knowledge. I am from Texas. I did my undergrad at SMU, so pony up if there's any alum here. They have an amazing entrepreneurship center. I am from a family of entrepreneurs, so I'm very passionate about this, of being able to educate entrepreneurs so you don't miss these big tax savings or you're not overpaying for taxes. Personally, I ski icon. I am trying to learn Spanish on Duolingo, so please help me there. And I love to travel. I do a holiday card every year. It's me and my cat are on it. So I traveled to Central Asia last year, and my cat is old now, so I Photoshop her in. So that's her, if you look closely. So a little bit about me, and again, here's our title sponsors, Amazon, Capital One, Emerge, thank you in the back for sponsoring People, Track, and again, just quick introduction. So let's get into building wealth in your business. So when you are starting your own business, there is a lot of education, not only on your product and how to get started, and it's scary to get started, but what type of entity should you choose? What are the pros and cons of each of those entities? What are the tax benefits? What are the tax pitfalls? For those of you that have already started your business, we'll talk about, does it make sense to change the type of taxable entity and why? So talking about types of entities first, and then ending with a couple miscellaneous tax benefits as well. So 4 common types of taxable entities. We have sole proprietorships, partnerships, limited liability companies, and then corporations. So most of these important term is it's pass-through or flow-through. So what that means is the business, you're reporting information, but you're not going to pay tax at the business level for those pass-through or flow-through entities. It will come to your personal tax return, and that's where you're going to pick all of that income or losses up. So first up is a sole proprietorship. So, this is the one-man band, right? This is just you. It's a single legal entity, and it's very simple. You can actually report this on your personal tax return with an additional Schedule C form, okay? So second theme in my presentation is that, I'm going to try to sprinkle some movies throughout, right? Hopefully this helps you remember all these terms, all these different things. So first up, we have Castaway. He's on his own. We're going to forget about Wilson. Pros of a sole proprietorship, it's easy to create. It's easy to manage. You're the only one making decisions. Everything's on you, right? And there's no distinction between you personally and you, the business. So simplified tax reporting as well, I already mentioned that. That's a pro for us. Some of the cons are that there is no distinction between the owner and the business. You have no protection from creditors from the business debts. There's little to no value to the entity without you. So that's really important if you are trying to grow your sole proprietorship to sell, if you are trying to leave it to a loved one. It doesn't have a lot of value without you. So if something happens, death, disability, all the gloom and doom in the world. Another con to sole proprietorships, when you are the employee and the employer, which you are in this case, you're going to pay payroll taxes twice. So that is that total, that 15.3% you see there. Second entity is probably the most common type of entity for smaller businesses, right? Not publicly traded. It's a partnership. It's basically going to be 2 or more persons. Doesn't have to be humans. Could be me, the owner, and maybe I have another entity that then flows through. It can get pretty complicated. You can form this verbally with you and your buddy, but usually it's always going to have a written agreement. The attorney joins the party pretty quickly. They have a bill, and it's going to be customized to the interests and goals of the owners and in that partnership agreement that you're writing and executing. You can also do special allocations, different treatments for capital contributions. Maybe you have a partner that has a lot of capital and you have a partner with no capital but a lot of talent. You can account for how they receive profits and losses differently. So lots of flexibility. And then last thing, there's going to be a separate tax form, Form 1065. That's where you report the activity. Again, no tax. It all flows through to a form Schedule K1 for the investors or the owners. And then you pick it up on your personal taxes. All right, now we got Sandy and Danny. Again, trying to have a little fun here. Taxes are boring, I know. So pros of this, it's still easy to set up. There's not as much regulation, and there is a lot of flexibility. So you can set it up however you and your partners would like, as long as you agree on how that's set up. Because there's multiple owners, it's going to make raising capital easier, as well as the business continuity, right? It's not just based on one person and their efforts. There is a way to transfer or sell ownership, to gift ownership. So lots of planning opportunities if that is part of your plan. Downsides, what are some of the pitfalls here? Well, somebody's still on the hook for the debts of the business. We would all set up our own personal business. I drive a car, somebody hits me, I have a partnership, so you can't touch me, right? So a general partner is usually going to bear that responsibility and the liability of the businesses. They're typically the most involved day-to-day and the most active member of the partnership. You can also have limited partners, self-explanatory, right? Limited partners, their exposure to liability is limited based on what they've put in personally. Lot of careful planning because there's so much customization. So how are you going to deal with conflicts between partners? The death of someone. How are you going to transfer ownership? How will earnings be distributed or accumulated? How will losses be distributed? The more partners you have, the more complexity. So this was in my graduate program for tax. This was a whole class. This was 6 months just learning about partnership taxation. So you can go, 20 miles deep on this. You want a really good attorney on your team, and you want to really like your business partners, right? I have a ton of stories about things going poorly when there's a conflict and you got to go by the legal agreement. So. Last thing here, self-employment tax is still going to come back around. Guaranteed payments, if that is on your K1, that's typically for limited partners, and that is subject to self-employment tax. Same thing with general partners, they're on the hook. That's going to be subject to self-employment tax. Third type of entity, limited liability companies. I really think of this as a hybrid between the two. You could do that partnership tax form, 1065, or you could do your personal tax return, that's Schedule C. So to me, this is, the Hulk. He can kind of, depending on the day, he's a hybrid kind of guy, what he looks like. So pros of LLCs, again, that flexibility in the ownership structure, how you're reporting it. It is a pro. You have some liability protection from creditors. And very important, write this form down. You hear about LLCs all the time. A lot of entities are LLCs. You want to make sure you file this 8832 form, and you are telling the IRS you're communicating what type of entity you are. So even if you are a sole proprietorship, that first type of entity, You want to file this to separate, basically church and state of, you personally and your LLC business that you are 100% owner of. So very, very important to make note of that. But it is a pro that you have that protection. Some of the cons are that, again, if you are saying your business is separate from you, you need a separate LLC checking account. You need a separate credit card. You should not be buying your personal groceries on your LLC credit card, right? You're going to get audited and they're going to say this phrase, piercing the corporate veil. You're not separating the two. They are one and the same. Therefore, the liability is one and the same. They're going to come after, your personal assets if you're not keeping this LLC separate and the activity separate. So very, very important, and a ton of business owners mess this up because we're all busy humans, right? Even if you have a spouse, you probably switch credit cards, however you account for your household expenses, it may be a little murky. So very, very important to do that. And then there may be some additional state reporting filing fees. Make sure you're educating yourself there to make sure you're meeting those requirements and you're not delinquent with the state. So last type of entity, I'm going through these quick because I want to be able to get to some really good examples for you guys. Last example is a corporation. This is really that standalone, typically not a pass-through entity. So you are going to have a formalized structure and administration. You're going to have additional reporting from these other entities with the federal government, typically with the state as well. And then the tax form is going to be Form 1120. So it's probably a little bit small for you guys, but pros of this, it's a completely separate entity. That is protecting you personally and the wealth you are building outside of your business to have all of the liability within the business. Same thing with partnerships. It's going to be easier to get investors, easier access to capital, because it's easy to buy and sell those shares of stock. Amazon's, sponsor of Denver Startup Week, we all know Amazon. They're a publicly traded company. That's what we're most familiar with. Most corporations are, publicly traded companies are corporations, the C Corp terminology. They can also have an unlimited number of shareholders. That's part of why they're on the stock exchange. If you're trying to grow your company to be acquired by another company or to go public yourself and sell to everybody that is interested, then a C corporation is going to be attractive for you. Last thing here, I think this is very specific to your industry and what you are selling or your product or your services. Fiscal years are allowed for corporations. What that means is we are all calendar taxpayers, right? January to December, get your business done. That's what we report on. Fiscal year means September 30th coming up, and I decide that's my year end for my business. So you're able to do that if it makes sense, again, typically industry specific. Some of the downsides of a corporation is there's a lot to do before you even open your doors and have revenue coming in, right? There's a lot of expenses. You're going to have a big team. You're going to have probably a couple attorneys drafting those documents for you. You're going to have, your accountant to make sure you're filing everything correctly. You have to wait and hear from the Secretary of State because you're doing your articles of incorporation, your company bylaws. So there's a lot just to even get started. There's additional administration on an ongoing basis as well. Additional filings, you need to have shareholder meetings and document things. Probably the biggest one with corporations is the double taxation. This is, what you may have heard. So this is when, again, it's a separate legal entity, so everything's going to be taxed at the entity level. It's also taxed again when it's dividends to the shareholders out. So this is, fun for people on the news to talk about tax rates. So it's been a flat rate since 2017 of 21% for corporations. Before that, it was 35%. We have also seen it as high as 53% in, our U.S. history. So this number does move around. Right now, it's relatively low at 21%. So, one other caveat, we've talked a lot about C Corps. This is something called an S Corp. So this switches that entity back to a flow-through. So we're basically in between the first three that we've talked about, and corporations. In S Corp, you do have to elect to do it when you form the entity. But again, it's a pass-through taxation. The entity maintenance in terms of filings and requirements, it's just, I just said more versus less. There's a cap of 100 shareholders, and you can only have US citizens or residents as shareholders. You cannot have foreign investors. So if that is part of your plan or a consideration, that's something between those two there. One stock of class of stock for S Corps, and then both have liability protection. Because an S Corp is a flow-through, it's going to depend on your personal tax rate, what you're paying, and then the dividend tax as well. So that's that double taxation there. So I just blasted you guys with a lot of knowledge. Hopefully people are a little bit awake, or you're like, oh, that's a good movie, I want to watch again. Forgot about Tom Hanks. So how do you choose these entities? Maybe you're at the front runner, you're a full-time employee and you're working on your side hustle, but you want to go full-time with your business. So how do you choose? We're going to walk through some examples. Again, I'm keeping this high level. We'll have time for questions if you have really detailed, what about this or that, and we can walk through that. So again, we have two casual owners, Bill and Ted. They're best friends, just good guys, and they have traveled through space and time together, and they want to start a luggage business. They want to repair luggage, and they want to build and manufacture. Expert craftsmen, they're really handy, but they've never owned or operated a business before. They figure they can, deal with the accounting on their own, do the books themselves, but they got a deal on a warehouse in, Broadway, we'll say. So maybe a shady area, they got a good deal, that's going to be their storefront, and they're worried that they're going to have the luggage all the way to the ceiling, people are going to come in, maybe the luggage falls on them. They don't want to get sued. They're best friends, so they're fine with 50-50. So the best type of entity for them is probably going to be an S corporation. It's going to allow them a lot of flexibility. Partners will be treated equally, which they're fine with, they're best friends, and easy to operate. They don't have to worry about special treatment, special allocations like a partnership, and they're going to have some liability protection with that S Corp as a separate entity. So another example, we've got a growing, ambitious team. I just called them the crew, but we've got Mikey, Brand, the older brother, and Chunk, the best friend, right? Hopefully you guys know this movie. They have been really successful in the past in their gold business. So they want to capitalize on that. They're going to start their own investment firm. They are savvy and they are ambitious, right? They're going to grow. They're going to have multiple ventures in gold, in silver, in rubies, all the natural resources. Those are going to be separate entities, separate investors. So they do want to give company equity to employees, but to start with, they're just going to be, divide by 3 of the ownership interests. So they are sophisticated. They're used to complexity. So an LLC partnership would work well for them. They're going to have flexibility to allocate things in a custom manner, profits and losses, as well as these future venture transactions. They can set those up how they would like, again, custom to them. Easy to transfer ownership, and they can start with an LLC and move to a corporation pretty easily. You will see that theme throughout if you don't take much from this. It is always easier to start as a sole to an LLC to an S Corp than to a C Corp. If you go right to a C Corp, you have a lot less flexibility. So LLC is a great place to start for most businesses. So our last business, they are very confident. They can predict the future. They know they are successful. Their company is going to be great. They haven't even opened the doors, but they're going to be gangbusters. They know the market. Harry and Ron are in the travel industry as well. They know everything. They've already brought their advisors from Goonies Capital LLC, and they met Bill and Ted on the street. They liked them. They liked their business. They want to buy their business too. So Bill and Ted are in the room. We got a lot of people in the room with us. Ron and Harry know they want a C Corp. they want preferred stock. They're going to IPO from 0 to, IPO in 3 years. Again, very ambitious, very confident. Again, I'm going to be this like gloom and doom and say an LLC is probably going to be the most flexibility for them because it's a pass-through entity, perhaps an S corp. But the LLC could purchase the assets of Bill and Ted's company, Excellent Adventures. That S corp could easily purchase the assets in that LLC format. A C corp may work if they are comfortable paying tax, again, twice, and if they want to issue that preferred stock immediately, as well as just have that flexibility to have any type of investor, US or foreign. So I promised some examples. I try to keep the math easy and fun. Here's our 2 entities. We have the S corp, which is Excellent Adventures. That's Bill and Ted. And then we have Broomsticks and Bags. That's the C corp. They didn't listen to me. They wanted to do the C corp. So they both had $1 million in taxable income. The C corp is going to be taxed at that 21%. That gets us down to the adjusted taxable income. And the pass-through entity, we have assumed the highest personal tax rate at 37%. Super conservative, but again, just for the example and assumptions, our federal tax system, personally, it's graduated, right? So you start at 10, then you go to 12, and it's a blend of all of that. So I'm going all the way to the top at 37 here. So the S corp is done. The C corp is not. It gets taxed again on the dividends, right? So when that's distributed, it's 20%. Fun little caveat in the tax system, we now have this surtax of 3.8% as well. So come all the way down, the after-tax cash, we have $630,000 for the S corp at the end of the day for the owners. The C corp is a little bit less, about $600,000. So doing the pass-through would save you about $30,000 this year in this situation. So again, a lot more flexibility for an LLC or an S corp. Last little thing, a couple little tax benefits. This is almost like tax trivia. So if you are already a business owner, you are planning to sell soon, you want to know your options to sell, these may be helpful for you. Qualified business deduction. This was also part of the 2017 tax reform. You may see it as QBI. You may see section 199A. That's super nerdy tax code section. This allows a 20% deduction for your taxable income if you qualify. So this is a nice little icing on the cake of additional deductions for you. It's only available for pass-throughs, not for C corps. There are restrictions around the type of business activity, as well as some income limitations and phase-outs for you personally. Basically, if you're married and you have around $350,000 of taxable income, let's say your spouse works, let's say you're taking some money out of your business, you're getting up to that $350,000. Things are going well, but if you're going beyond that, you're not getting this 20% deduction. So again, same example here. We're going to add on that QBI. So Excellent Adventures, they're going to get that 20% deduction, assume they get the full amount. That takes their new, it's hard to see in the green, sorry about that, the new taxable income down to $800,000 from $1 million before. Pass-through tax, still calculated. Again, we come down that the S corp is about $700,000 of after everything's said and done, the cash for the owners to split. C corp, same number, about $600,000. So with this, you're seeing the difference. It's a much more significant difference, right, between S corp and C corp. Again, trying to make this lighthearted. If you take nothing else from this, but you have a pass-through entity and you're like, oh, I really like this QBI, my accountant hasn't told me about it, write down this resource, that online calculator resource. It's with Intuit. You can also just Google Intuit. They do TurboTax. Intuit QBI calculator. Much more detailed than that example I walked through. And so if you are in an active business, this is great to be able to kind of do your planning, work with your accountant and say, hey, should I have more income in my business this year? Should I have more expenses before year end? There's a lot of planning to do. with this, especially because the QBI deduction is scheduled to sunset the end of 2025. So, accountants, we are nerds ever long. All of these tax reforms that come out typically do sunset. So there's a lot that are coming. A lot of these rules that were passed in 2017 may go away in 2025, end of 2025. So, and you can also email me, and I'm happy to send the presentation or this link as well. So last little thing, Willie has worked a long time in his business, loves it. He's ready to sell his business. So this qualified small business stock, QSBS, code section 1202. Basically, this is for smaller C corporations, not for pass-throughs. We had a deduction for pass-throughs. This one's only for corporations. It has to be a small corporation that is classified as 50 million in assets or less. And it has to be certain sectors and certain industries, right? So financial services, I don't qualify for this if I were to sell my business. It's only certain industries. Typically, if you're selling widgets, if you're, Willie, you're selling chocolate. So you must be the original investor as well. So certainly owners, this would apply and save you on your capital gains. You're eligible, again, I skipped over that, but to exclude 100% of the gain on the sale. So you have worked, this is your whole retirement plan. Willie's whole retirement plan, right, is his business. He didn't save anything, and he's single. He's on his own, he's got to make this work and get the most for it. And now he's not going to pay tax on it either, which is a nice little chunk of change to keep the all of the liquidity from his business. It depends on the date you purchased. And then, again, this will qualify for Willie, and then his family and friends, right? If you're a business owner and you're like, hey, I need some capital, it's a partnership, mom, dad, here's my business plan, would you like to invest? They would also qualify for this. Maybe you have better friends than me too that loaned you money. Example, we got the Mo, Larry, and Curly. Here I've just really highlighted the different purchase prices. I won't go over this in detail too much. We'll just talk about Curly. Basically, anyone who has purchased 2011 or later, that has invested, created a business 2011 and later, that you then sell, you'll be eligible for that 100% exclusion. So Curly put $5 million into the business. He sold it for $20 million. So he's got $15 million in cash, sitting around. That's his gain, he has $20 million, but the gain is $15 million. He's not paying any tax on any of that, any capital gains with this exclusion that's available. So this is very, very powerful if you are a business owner and you don't want to IPO. You don't want to have this as big as possible. You want to retire at some point. This can save you, in this example, it can save you up to $3 million. So that's a lot of your hard work that you're keeping and not paying in capital gains tax. So that was everything in the business, talking about the business structure, how it's set up, tax considerations to think about. Now we're going to switch out of the business. So this is going to be, how do you pay yourself, right? How do you, all of the spouses I work with, I love working with business owners. They are just Chihuahua energy like me, right? I love it. Always new ideas, moving really fast. Opposites attract. The spouse is typically not as risk tolerant as the entrepreneur, right? They are worried about cash flow. They are worried about, taking care of the family and other needs besides the business needs. So how do you take liquidity and cash flow out of the business successfully in a tax efficient manner? So same thing, we'll walk through really basic retirement accounts. I hope everyone's familiar with some of them, but I'm still gonna go over them. The self-employed ones we'll spend a little bit more time on for you. We'll talk about how to choose, when to switch, and then if you're a bigger company, you have a lot of employees on your payroll. Again, you're Ron and Harry, you're blowing and going. We'll talk about other options there, what you can layer on top of. So types of accounts, again, 4 basic types. I've tried to keep this simple. We're going to talk about first a Roth IRA and traditional IRA. So these are a little bit different. So Andy, she's just starting out. It's her first job. She's on the payroll. She's not self-employed. So a Roth is great when you first start working because there are some income limitations that, as you get going in your career, especially as a W-2 employee, you may not be able to contribute. You may start to make too much money. The nice thing about a Roth is it is tax-free growth once it is in there. So I love this for younger workers because they have typically a longer timeline, but this is great for everybody. This is my favorite account. We would go on a walk together every day if we could. You only pay tax once, $6,500 a year. That's for 2023. It's adjusted up a little bit every year. You get an additional catch-up. That's a consistent theme throughout. If you're 50 plus, they want to incentivize retirement savings, right, as part of public policy. Let's see, what else? No required minimum distributions in retirement. This means that you don't have to take money out of this account ever if you don't need it. Maybe you sold your business for $20 million and you've saved along the way into this Roth. This is a great account to pass on to kids, grandkids, your senior cat if she outlives you. Contrast that with Dolly. She's never going to start her own business. She works 9 to 5 and that's it. She's been there a long time. She saves into a traditional IRA. This is tax deferred growth. Tax-free versus deferred, right? When you are in retirement, you're going to be required to take out at some point. The IRS comes knocking and says, hey, we gave you that discount a while back on your taxes. We do want you to pay at some point. Required minimum distributions, RMDs, used to be 70 and a half is when you would start. Now there's a bunch of different ages with the most recent tax reform. You want to know your date of birth and then look up when does that happen for me. So the reason I put these two together is there is a really great planning opportunity when you do start to make too much money to contribute to the Roth, but you love that Roth account. You say, how can I keep getting money into that? So this is called a backdoor Roth contribution. I didn't come up with the name. I think it's terrible. What you will do is your traditional IRA your contributions will either be deductions, meaning you get credit on your personal tax return, or you can still contribute, but you don't get credit on your tax return. So if you don't get credit, it's basically called a non-deductible contribution. That creates basis. So with that basis, we're step 1, you've added it. I recommend not investing it. Period of time, people have different schools of thought. How much time? But then you can take that contribution you made that has basis in your traditional, move it over into the Roth IRA and convert it in that way. You do want to document and tell the IRS what you did, that tax form there, that 8606. Again, if you're already doing this, but you're preparing your own taxes, also make note of that. You do want to file the tax form to notify the IRS there. And then last step, you can do this every single year. Won't go into all the details of why this is really important, but basically if you worked for 10 years before you started your own business, let's say you have $500,000 in your traditional IRA, you want to do these backdoor Roths, you're not going to be able to do it with that $500,000 in that traditional IRA already. We really want this pristine, clean traditional IRA that basically has a zero balance to be able to do this process each year. If you have questions about that, come up to me after. I have some other tips and tricks to help fix that. But next type of accounts, SEP and simple IRA accounts. So now we're getting into the self-employed land. Maybe you're W-2, you can do a Roth, you can do a traditional IRA. Everybody can do those. SEP and simple, these are for self-employed owners. So think of this as that traditional IRA for each employee. So you are the employer, you have your employer hat on and you have employees and you want to set this up for them. They each have their individual account. Employees cannot contribute to a SEP IRA. It's in their name, it's for them, they cannot contribute to it. The employer is the only one contributing to it on their behalf. So, nice little Christmas bonus. The business owner, you are doing this because those contributions are tax deductible for your business. Helps with retention, right? Your employees are happy, they got their bonus. they don't do a good job saving for retirement on their own, you're helping them. And guess what? The business had a really good year. You can put more in that account on their behalf, but you are not tied into that amount every single year. So there's a lot of flexibility with contributions on an annual basis. Contribution limits there in pink, the $66,000. And this one's super easy to set up, administer. A lot of the, the investment decisions are pushed to the employees. So you are not, making those decisions for them. Simple IRA, I'm not as big of a fan of, but you do see a lot. It's very similar to a SEP IRA. It does allow employees to contribute on and save on their own. So we have, employees are adding, and the mandatory employer contributions, that's mandatory. You don't have as much flexibility. It's a calculated amount, and employees can't contribute as much. So if we're between, we'll do a comparison, but just keep in mind this one's not my favorite. Same simple setup and administration though. So now we're gonna move to the solo 401k. Same thing as individual or solo. This is probably my favorite for business owners, right? You have your LLC that you set up, you are doing consulting, working from home, you're doing great. This is my favorite savings vehicle for you. There's no age or income restrictions. So let's say you worked for 40 years for the city of Denver, you retired, and now you're doing some consulting on your own. It's gone way better than you thought in your free time, and you set one of these up. There's no restrictions based on, again, age or, you're making too much money like the Roth and traditional IRAs. You can also add the Roth options, so you can have that tax-free growth if you want. Employer contributions as well as employee contributions, so we have both of them there. And there is some additional paperwork, bookkeeping. You want to have your account at a good custodian. You want to make sure you're filing the tax form saying, hey, this is a separate entity from me. This is my retirement plan. If you already have one of these, a lot of people miss this, accountants included. You need to tell your accountant if you have more than $250,000 in this individual 401k. There's an additional reporting form, even if you're the only employee. So we've got our solo 401k. We have maxed out our employee amount, that $22,500 for 2023. And, we're moving and grooving. We want to defer as much of our profits as we can. So we are going to add our employee match. We'll say you're making $200,000 in wages. You're giving yourself a 6% match. We got $12,000 there. And then, Allie, where'd you get this $31,500 for a profit share? Profit share, again, that's discretionary. Very similar to that SEP IRA that you can add, you can decide to contribute to that if it makes sense. Don't have to do the same amount every single year. So these three amounts magically total up to $66,000. This is really the most you can defer of your profits of your activity and put in this tax sheltered vehicle for your future self. So profit share is great to kind of add all those things up. One other planning technique is, remember I said there was an asterisk a couple slides ago said no employees. A spouse is an exception to that rule. Now they do have to work. They can't just be the therapist listening to you, complain about the business, right? They have to be checking the mail, maybe helping with the bookkeeping. They have to be adding value and taking a salary from your business. But this is wonderful that maybe that spouse is staying home and contributing at home. They're not necessarily, out on their own as a W-2 employee. Basically, you can set up a spousal 401k as a sub-account of that individual 401k. So this is really magical because we already got $66,000. We're so excited about that. Well, now we can get $132,000 of your profits into a tax-deferred vehicle, potentially. So this can be really powerful. Again, federal tax savings of about $50,000 in 1 year. Again, assuming highest tax bracket. But this is a really powerful thing that I don't see enough business owners doing. Last thing, I'm going to go through this really quick because this is typically if you have a lot of employees, your business is really scaling up and you're kind of adding on all these other things. So you've graduated to a company 401k plan. And most people are familiar with these now, right? Most larger businesses, if you started your career at a bigger firm somewhere, they're already going to have this. We have some vocabulary around this, hopefully. There's various plan types. The most common one you see is one called Safe Harbor, which basically means there's a mandatory contribution from the employer into the employee's accounts. So that is deductible to the employer as a business expense. But again, you're incentivizing employees to stay, right? They're happy, they're getting some free money. You're helping them save on their behalf. So the Safe Harbor for employers, the benefit of that is it's a little bit of a cheaper plan. There's less testing. Again, the whole public policy concept is that, we have these things set up. You're a 401k plan. You are a fiduciary. You are in charge of taking care of your employees and their funds. Kind of harken back to the Bernie Madoff days, right? That we have these laws in place so employers can't take advantage and take money away from employees. So that Safe Harbor, there's much less testing, there's a little bit less regulation because they assume, hey, you're putting in this minimum amount, you're taking care of all employees, you're not favoring yourself, the business owner. So we have that. You're going to have more third party, you're going to have more people on your team. You're going to have a record keeper. You're going to have a third party administrator. You're going to have a custodian because you can't take money for employees and put it in your own pocket and say, oh yeah, I'm keeping an eye on it. It has to be with a third party, separate. Same employee limits that we've talked about, very common. Again, using Amazon as an example, their 401k plan, no one can contribute more than $22,500 if you're under 50 years old. Annual maintenance, there's some additional costs to this, right? Above and beyond maybe the SEP, maybe the simple, if you're putting this 401k in place for your employees. Other qualified plans, even I get as confused as Morgan Freeman. I've done this a long time. Again, I got all these letters behind my name. I know all the rules. I can't remember them, right? I have to go back and look when I'm making these decisions for a business owner of what's best for them. These are just other types. I kind of put these in the bonus. Like if you're doing really well and you're like, oh, I hate paying all this tax, and we've already done all these tax saving options that we've already talked about, this can be really nice too. We can add on a cash balance plan. We can add on a defined contribution, a defined benefit, maybe employee stock ownership. I've worked with several breweries and the owners. Breweries love to do these ESOP. Again, we have a lot of jargon. This employee stock ownership plan. They like to give this, again, to incentivize their employees. It also benefits them on the tax side. So how do you choose? You're like as exhausted as me going through all these different vocabulary words. So I like this comparison summary. I'm not really going to go over the simple IRA. You guys already know it's not my favorite. So we're really between a SEP and a solo. You're kind of on your own. You're doing well. You have some extra cash laying around. And you got the tax bill in April. And you're like, whew, I don't want to do that again. I don't want to be this successful. That was a big bill. So SEP IRA and solo 401k both have the same maximum annual contribution amounts. The solo 401k is nice because you get a catch-up if you're 50 or older. So this is nice. If you're feeling behind, you can save a little bit more into that. Employee deferral amounts, SEP IRA, right, if you remember, only the employer's putting in. Employee can't do anything. So solo 401k is nice there. Has the toggle for the Roth, my favorite. And then most importantly, we didn't talk about this. You can add a loan to your solo 401k. You're setting up the administration and the rules. You can choose to use this as your kitty if things go wrong as part of your emergency savings to take a loan from here. So if you're having, liquidity issues or it's a bad year, this can be an option. You're not going to have the penalties taking the money directly out of the retirement account like all the other ones. So people are like, oh man, I'm behind. I'm never going to retire. This stinks. Like, what do I do? So I encourage people, first of all, you read all these, I'm telling you all this information, you read a lot online about all the things you're supposed to do. There's a lot of different ways to be successful in retirement and as a business owner. I always encourage everybody to start with an emergency fund that just sits in cash. You can put it in a money market account. I like bankrate.com. They're kind of a general provider. They just have a list of banks and what their interest rates are. Most of them are about 5% right now with how interest rates have come up. 5% to sit in cash is a pretty good deal for me. You want to have that set aside. Then we can start building on these retirement savings. I love a Roth IRA. I want you to fill that up if you can, either directly or with this backdoor method that we talked about. And then we're going to move on to a tax-deferred account. That's going to be your SEP, your Simple, your 401k. And then we're going to max that out. If we can get to that $66,000 number next, that's the goal. And then a taxable account, that's really, you got the extra slush laying around and you don't want to reinvest it in your business. That's unlimited. So quick example here, the $60,000, this is 3 or 6 months of living expenses for you personally as well as business expenses, right? So we want that aside. Doesn't matter which account you put it in and how you account for it. We've got $6,500, we've got $22,500. We're getting up to the total of $43,500. So this is really, if you're looking for, you're like just tell me A to B, Allie. This is like the A to B, not knowing anything about your situation. So very last thing, and we will have time for questions, which is awesome, miscellaneous tax benefits. So, Willie decided not to sell the business, but he's going to take care of his employees now. So there is, again, part of tax reform that came out. This was the Secure Act 2.0, passed at the end of 2022. It was around the holidays, didn't get a lot of press like a lot of the other tax reform. So this is to incentivize business owners for a startup tax credit. So you can get up to $5,000 for administration costs, startup, education for your employees. Any of those costs you spend, you get that back first 3 years of the plan. So this is really nice if you're feeling like, hey, I want good employees, but I'm still feeling a little tight on cash. It doesn't really cost you to get this set up with this startup tax credit. There's also a separate tax credit, that third bullet point, this auto enrollment. So that's an extra $500. Maybe you already have a 401k plan for your employees, but no auto enrollment. Go do a plan amendment, talk to your administrator. It's an extra $500 for you. It doesn't cost that much to amend your plan to do this auto enrollment. Typically 100 or less employees. So again, small businesses. This is not for the Amazons of the world. Employer contribution tax credit. So last tax credit here. This was also added end of last year. In this example, we're going to have 50 or fewer employees. So maximum credit, $1,000 a year per eligible employee. So we've got 15 employees. You're all about getting this credit back, so you are going to match, but only up to $1,000. So first 2 years, we've got $15,000 that you've paid in. You're getting all of that back with this tax credit that you've paid. The various percentages the rest of the year, the 3 through 5, 75, 50, and 25. Potential tax savings over 5 years is over $50,000. So again, some of these seem small and you're like, what's the point? But right, you're the business owner. This is all real. Cash flow is king. So the more you can get some of these back and the less you can pay to taxes legally, that's all you're able to reinvest back to your business and your employees. So last thing here, this is the only tax form I have showed you guys. You're welcome. This is Schedule C. This is when you're that solo business owner, it's just you. These are all the deductions available to you as a business owner. These are all legal. These are, part of the tax code, right? So if you are a Schedule C, or if you're trying to learn more, learn more about each of these. Are you taking advantage? The big one's home office, right? Even with quarantine the last couple of years. Home office is huge. Travel, what qualifies there? What are the rules? Employee benefit programs, all of these line items, it's basically dollar for dollar, right? So if you made $100,000, you have $50,000 in expenses. Now we're starting at $50,000 that you may pay tax on. And then we're going to continue down the tax formula. But this is a lot. People kind of forget about this, or they don't want to be bothered to keep track of things, but it could be worth your time if you're organized, or hopefully your accountant's educating you on this as well. So last couple of things, we talked about building wealth in your business and ways to do that. We talked about ways to take wealth out of your business and pay yourself before you sell or retire or wind down your business. A couple other things to think about. You want to coordinate your team, right? You may not have all these people on your team. You may not need all of them, but these are all important players when you are building your team. And I love nothing more if someone just emails me and says, hey, just an FYI, here's what you need to know. The more you are telling your team, the more they can help you, right? There's no way everybody can know all these tax codes I went through. There's no way, I don't know anything about business valuation. But that's really important if you have a partnership and you're valuing it and trying to sell it and grow and sell off a percentage, every other year. These are all important parts. Most people start with an accountant and an attorney, right? And hopefully a very supportive spouse. So very important there. And just keep in mind, I always say, I'm an advisor, I'm a planner. I always say make a plan just to work the plan. The plan's going to change the minute you make it. That's not the point. The point is that, you have your vision and your why in writing, and you're communicating that to your team. They all know, the way the boats are rowing. You want to regularly update on the goals and objectives and be able to celebrate. We all get kind of in the minutia, right, as business owners of, just the day-to-day things. But make sure you're celebrating. And again, with your spouse or your family or your support network, celebrate the personal successes as well as the business success. A couple other things on this are this is the gloom and doom meeting is what I say for clients. We want to talk about death, disability, and divorce, right? Those are all things we hope never happen. We know one will eventually, but we hope some of them don't. But what happens if you do? How is your business positioned? Do you have a buy-sell agreement? Can your partner buy out your interests so your spouse is taken care of? Do you have life insurance for the owners? Do you have other insurance, right, for when the luggage falls? Are you mitigating or minimizing just known risks? You're not going to catch everything, but are you taking time to think about that and be strategic? And then again, beginning with the end in mind. At some point, your business will wind down. Hopefully it will be sold. Hopefully, if there's a succession plan, your goals are for a family member to take over, a younger partner. But just beginning with the end in mind, 2/3 of family-owned businesses have no succession plan in place at all. That's very, very scary. There's nothing. They haven't even thought about any of this, much less put something in place. So with that, thank you so much for your time. I'll open up the floor for questions. I'll also be up front after 1 o'clock. If you have questions, best way to find me is on LinkedIn. Feel free to message me if you want copies of anything. I love it. We have all the questions already. It means I wasn't too boring. What do you got?
I have a couple questions. You mentioned
Thank you.
Employer contribution tax credit. Does that apply if you're contributing to the individual 401k?
It does not. It's only for, you have to have employees beyond yourself. But yeah, good question.
And then about that, so I opened up an individual 401k earlier this year and have not done anything with it.
Yeah.
You mentioned that the contributions to the SEP IRA are tax deductible. Is that also the case for the individual 401k?
Yes, correct. So that's the biggest. It will just be part of your business return that you're filing. So yep, you'll see a line item, or if it's a separate form, it'll be clearly noted. The nice thing about SEP and individual 401k that a lot of business owners like, that deadline to contribute is actually later, right? So year ends 12/31. You actually have until April or sometimes October. So it can be
If you have an extension, if you file an extension.
Yep, and maybe you don't know your income, you don't know your cash flow. It's really great to pay yourself more and not pay more in taxes, right?
That's actually my next question is for the individual 401ks, is the employer
It's your compensation as an employee.
So
So,
it's just been like what's been like I have an individual service business. So
Yep.
it'd just be like what I have transferred to my personal bank account basically.
it's what you're paying FICA tax on, actually, like your self-employment income, right? So you can, and this is where business owners are fun, right? It's like, do you pay yourself but pay FICA, or do you take a distribution from your business but don't pay FICA? So it can get a little bit, FICA is your payroll taxes. So
I don't do that. I have a what's it called? LLC.
you are paying self-employment tax then, yeah.
That's the pass-through style, right?
Yep.
So that's my like net profit. That's considered.
Yes, yep. So your bottom of Schedule C, and then that'll flow, and you're paying self-employment. You get credit for half of it, which is nice, but you're paying tax on all of your
So I
income.
can contribute up to 25% of my net profit.
Yes, correct. Yep.
Cool. Thank you.
Yeah.
Hi, small business owner, works with my wife sometimes.
Let's get her on the payroll officially.
Tangential question, how old do my kids need to be so I can hire them? There is like a $12,000 limit you can pay them,
Yes.
but it reduces my tax exposure.
Great question. There are some articles out there. I'm just going to pick a number, but you can still research. And if they're hustlers at 8, maybe you can put them on earlier. I'm going to say 12. You can go, 10, 11. Yeah, you can go 10, 11. Everything, right? Account taxes. It's fun because I like knowing all the rules to know how to bend them. That's why I like taxes. If your kids are actually adding value and it's documented and you're paying them a reasonable wage, that's the other one where the IRS will get you. They can't go get the mail for you and you're paying them $100 a day for a 2-minute job. You can pay them $20 a day.
Something like that, right?
Yeah. If they're actually adding value and it's a reasonable compensation, absolutely whatever they earn, you can, basically put into a Roth IRA for them, and they're, ahead of me in the game. So it's a really good idea. It's a very common planning technique as well. Not enough business owners take advantage of it, so you're smart to think about it. Hey, there's models. You could have a model or something, it would be, but if they're, yeah. This is a little Dance Moms example. It's not a movie, so, yeah, of course.
I'm wondering what does it look like to take a sole proprietorship to either an LLC or an S corp?
So typically, actually, the sole proprietorship is kind of your quick and dirty that you set up. Most LLCs are sole proprietorships. The only difference is going to be that specific form 8832. You just want to file that. Basically, that's going to give you that liability protection, but you are still the only member of that LLC. So the sole proprietorship, I start there because it's a baseline, but most of them are LLCs. So good question. Same thing with an S corp. You can have one shareholder in an S corp, right? A lot of business owners do that too. Yeah.
Recommendations for community resources to help navigate some of this stuff?
Yes. I'm always available if you want to get a good accountant. They're probably going to be the best resource. You're kind of on the clock sometimes, right, with accountants because they have an hourly rate. I cannot think of the name, but if you email me, I will send it. But it's like the Denver Center for Employee Ownership and something. It's a long name because it's a city entity, but they're great. There's also some nonprofits that, help with small business owners. And then I would also just say, you're here, like network as much as you can. And, I'm happy to answer specific questions. And, we want to help the community because I think 50% of businesses are small businesses, right? Like these are the engine of the economy, right? It's not, Amazon's great. Thank you for sponsoring us, but it's really the small business owners, right? And so, but yeah, we can chat after too. So I thought I saw one more hand. Oh, in the back. Did you have a question? Yeah, sorry. You, yes. Yeah, go ahead. Oh, you're fine. There's just that one light, but I can't see you. Yep. That's a great question. So his question, if you guys couldn't hear, is just I love my business. I don't want to sell it. I don't want to ever retire. The Exit Planning Institute, they have a lot of resources as well locally. Again, I make jokes about therapists, but like it's emotional, right? It's your baby. So it may help to talk through that and have value in your self-worth outside of your business, right? Business owners, it's a lot of hours, it's a lot of your time and energy, and that's why it's successful, right? Like, so that can be difficult. What I have seen with most business owners, to your point, is they sell and then they start another business. So it's not that you're only a business owner once. I typically see once people go this route, they're a serial entrepreneur and they just have a ton of ideas. They put their best idea together, and at some point it's time to move on. It makes sense financially, maybe emotionally to do so, and then they're on to their next best idea. So I don't know if that answered, did that answer your question? Okay.
I have a remote online coaching business.
Yep.
I have an LLC, but it's just me, and
Yep.
I'm not trying to be like the next Amazon, so
Yeah.
I don't plan on having a lot of employees. It's like an assistant at some
Yep.
point. And I already have my finances separate, but I'm curious if when I go to pay myself from my business account,
Yep.
if there's anything wrong with simply doing an external transfer, or do I need to be writing myself checks, or like?
The transfer's fine. You want to track it. This lady's question up here is a little bit similar to yours of like, this is when you get into that type of entity, because the more you pay yourself, depending on the entity, the more you may pay in tax with FICA and self-employment. So that's when this retirement solo 401k comes in that I love, because you're still paying yourself, but you're not paying tax on it in a lot of different ways. The other thing to think about, and I lost my train of thought, so I'm sorry with that. I know, yeah. I didn't have enough coffee this morning, so.
The more money I leave in my business account to not actually pay myself, the less money I get taxed on, because the less I'm taking.
Correct. Yes, and my other thought was this is when a lot of people love S Corps and go to that, because how S Corps work is it is pass-through, but S Corps are a little bit different in that it's only what you take out of the entity. So I had a business owner, he was 100% owner, he wanted to bring on a younger staff member, but he hadn't been paying tax. He had all these accumulated earnings from the last 10 years in his S Corp. I told him, hey, you got to take some of that out. Otherwise, this new partner that's coming in, he's getting some of your earnings from the past 10 years. Yeah, you haven't paid tax on them, but you're giving it away the other way. So that's the other thing with an S Corp that does require a lot of planning and understanding of that structure of how much to take out every year. Because it's not bad to pay tax. We are actually in historically low tax rates right now. For personal owners, they're scheduled to go up in 2026. So everything I'm talking about with my clients is like, hey, we're looking over your lifetime. You're going to pay more in 3 years. It's not the worst thing to pay now, but you want to understand the pros and cons of doing that. So that's, even though you have a simple business, there could be a little bit more there that you could do to save on taxes or just to think around. So, yeah.
You talked about tax deductions as it relates to a home office.
Yep.
Is it a flat? So I understand it's like you get X amount and that's it, or is it?
There can be like a de minimis rule. So it's like reasonable. I'm taking, my mortgage is $2,000. I'm taking $200. If you want to really be a tax nerd and get into it, the square footage of your home office in relation to your total square footage. And then it's, let's say it's 20% of your home. It's a massive office for whatever reason. Then you're getting 20% of all of your bills, your mortgage, your utilities, your internet. Sometimes your internet can be 100%. So it can, again, if you're documenting things well, if you have an accountant that's like, okay, going into the gray, maybe a little bit more on those deductions. Again, as long as you're following the letter of the law, there could potentially be more there for you. So, yeah, go ahead. Yep.
The weight, 6,500 pounds.
Yep.
But lease versus purchase going into that. Can you explain something on that as it relates to deduction?
So I believe, and I am a little rusty on that, so it's a good question, but I believe the lease would qualify 100%, and you're maybe don't have to worry about the weight and all those things. Doing the car payment, sometimes it's a percentage, right? How much is personal use versus professional use. You can also just do mileage. So if you have a mileage tracker app or do something like that, that's more of a straightforward calculation as well. But, again, depending on how nice of a car, how much it costs you, and your business income, it's, do you want to spend your time and energy on that? Or, what are some of these apps out there to help you do that? Or, make your decision and move on. Don't read any of the other articles saying that you missed out on deductions, because yeah. Go. Do you have a question? Yeah.
So you had an example up there with this C Corp
Mm-hmm.
on the exit.
Yep.
If the buyer purchases the company stock, I believe.
Was that Willy Wonka?
Yeah, I think so.
Yep.
Then you weren't paying tax on the gain, right?
Yep.
So a couple questions on that. Does it depend on how the buyer is buying you? Like if they're buying company stock versus an asset purchase versus, is it a disadvantage for them to do that? Because it seems like, myself included, a lot of folks have not done that, have sold more as an S or an LLC
Mm-hmm.
partnership.
Yep.
And then we're subject to all the gains. So
Yep.
if those companies would have taken one more step to a C Corp, have they avoided all that? Or
Potentially.
it depends a lot on the buyer.
Yeah. It does depend on the buyer, and that's part of, the other thing I didn't mention, but I really wish business owners would talk with their team 5 to 10 years out. A lot of time business owners are 2 years out, and all these tips and tricks, we can't pull those out for you.
Yeah.
We're going to maximize the value, and we want, if a buyer's ready and that's the best price, yeah, we're going to do it and we're going to pay the tax. But yes, it does have to be a C Corp, and then, that's a negotiation with the buyer, right? Of like, hey, you got to take maybe some assets you don't want because you're taking the whole business, but you can help negotiate that, and, maybe you're taking, it's worth 20 million, but you're okay taking 18 million because you still save $1 million, right? Or more.
But if they buy the company stock, all the liability with that C Corp comes along with,
Yeah.
or if they do an asset purchase, maybe that liability.
Yep, which I have, I would love to do. I wish I had done like a 2.0 on all the sale, because there's so many different things, and the same thing, tips and tricks, but.
But to your point, there's a lot of variables you have to look at and
Yep.
build that into the negotiation.
Yep, and a lot of times too, I will say to your point, people are just looking at that $20 million number. They're not looking at the net number, and you really, really want to do that after taxes and help with your negotiation. So it's smart to be thinking that. So I know we're over time, so I'll be outside. Feel free to, come. I love all this stuff, so come ask questions. Doesn't bother me at all. But thank you guys so much, and great audience for how quick I went and how deep this was. So thank you guys.